Hello and welcome to NDTV Profit. This is the portfolio manager and my guest today is Gaurav Mehta, who is the CIO Alternatives Equities at SBI Fund Management. Gaurav, thank you very much for joining us today. You manage a equity portfolio which is quite large. Give us a sense of how you go about, investing across asset categories, especially like market cap categories like large cap, small cap, and mid cap.
Right, so I think, I like to sort of break down our total assets into two categories. One is obviously the institutional mandates that we run on the PMS side, where largely we deal with ETFs and diversified funds and so on. So there's very little direct equity exposure there. But the more sort of retail PMS is where we take direct equity exposure, and we have two schemes at this point in time, ESG PMS and the Eon Alpha portfolio. But I think the overarching principle for us is that, as you have seen so much of flows into mutual funds, what's actually happened is that the investable universe on the mutual fund side has started to shrink because, several of these small companies, you can't invest, let's say, in a large fund because there is not that much of free float available, or even if, these are like, think about 1,000-2,000 crore market cap company, it becomes very difficult to get a decent exposure there in a large mutual fund scheme. But alternatives and PMS is where you have relatively smaller sizes, and to that extent you can buy these stocks and concentrate to the extent that you want. The other thing is, then as you go down the market cap spectrum, there is research arbitrage that's available, right? So a 2,000 crore company, if it's not worthwhile for a large institution to bother about, then a lot of sell-side analysts, etc., also tend to ignore these names. And which is why there is a research arbitrage there, that if you spend the right energies and efforts, then you can create a differentiated view on that company versus a large company which is covered by, let's say, 100-200 analysts across the world. So this combination where there are several unexplored names where there is research arbitrage available, and your ability to express yourself freely across the market cap spectrum means that we typically run portfolios where we don't necessarily have to bother about the market cap. So a good large cap is as lucrative for us, but a good small cap is even more lucrative to us because of this research arbitrage element, and which is why the portfolios that we run usually tend to be a little more skewed towards mid and small caps. That said, these are multi-cap mandates. So to that extent, I don't have to ignore a large cap if I like it. But if you just think of it in number terms, there are 100 large caps by SEBI's definition, 150 mid caps, and there is at least 1,000 odd decent small caps out there. So if you have to randomly create concentrated portfolios, which is what we usually do on the PMS side or even for AIF, then you are just looking at 20-25 holdings at any point in time. And to the extent that there, just 10% of, let's say, the top 1,000 companies is large cap, 15% is mid cap, and another 75% is small caps, there's a good chance that, if you're just long-term in nature, bottom-up driven, and creating a portfolio of 20-25 stocks, you will end up with a disproportionate number of small caps, just sheer, numbers and base rates and probabilities. And which is why, and that's the skew that you typically see in our portfolios, that this is not as much as 75%, but let's say we are comfortable owning 40-50% of the portfolio in small caps and the remaining in mid and large caps. So it's very market cap agnostic.
How do you look at liquidity? Because small caps have this liquidity issues. So even though if it's a 2,000 crores or 5,000 crore company, entry and exits are are price sensitive in that sense, right?
Absolutely.
So as a PMS and AF, how do you manage that kind of risk in your portfolio?
Right. So there are 2 or 3 aspects to this. I think the first aspect, as I mentioned earlier, is that versus a conventional mutual fund, AIS and PMSs, because they are nichely distributed, they tend to be relatively smaller in size. So that takes away that disadvantage to some extent. The second thing is that, we have access to one of the largest research teams in the country. So we have, 15 to 20 dedicated equity research analysts. And which is why, we spend a lot of time on the long-term fundamental merits of a company rather than focusing too much on here and now trends. And to that extent, in general, our positions are companies where we would typically want to be invested in 3-5 years or even longer than that. And which is why that sell decision or your ability to sort of keep moving in, moving out, and hence bother too much about liquidity becomes less relevant. I'm not saying it completely takes that away, but it becomes less relevant. And the third aspect is that to complement this large research and investment team, we also have an equally strong risk team in risk compliance and all those teams in place. And which is why there is a proper risk template that we follow for each of these funds, which takes care of the liquidity aspect as well. With respect to your total AUMs, what proportion of your AUM theoretically, if everyone puts in a redemption, can be liquidated in 10 days, 15 days, and so on. So I think that again acts as a check and balance that while we want to be, flexible in terms of moving across market caps, we also are cognizant of that illiquidity risk. Although, as I said, it's less relevant here, but that risk template ensures that to whatever extent it's relevant, it's completely adhered to.
You also have this institutional portfolio which is there. And within the institutional portfolio, while a large portion for pension funds and others is into debt, the equity portion is more into ETFs. Do you look at small cap ETFs or is it active ETFs that you look at when you invest?
So I think in a typical institutional mandate, it varies depending on the client, but usually you can invest up to 15% of money in equities, right? And there again, I think there's a limit of about 5% that you can put in diversified funds. So usually our approach is to, and again, this will vary depending on client mandates, the market situations and circumstances and risk appetites and so on. But typically 5% goes into active funds and about 10% goes in index ETFs. But largely, our approach is to keep it into liquid ETF, as in the large cap end of the market cap spectrum, although we are not sort of constrained by that. But usually that exposure is not too much into a thematic baskets like, let's say, a small cap fund or a sector fund or so on. It's much more diversified and usually more skewed towards large caps.
So you have two funds. One is the SBI ESG fund and one is the SBI EON, which EON is mainly into mid cap and small caps. ESG is basically you're looking at how the call it a governance and how they're friendly to environment and others. Do you have enough pool of stocks which fall into that ESG pool for you to invest? And how do you assess those stocks? Right. Because ESG has different meaning for different AMCs and asset managers, yes. And there's no common way to read them.
No, absolutely, and which is why we've tried to objectivize it to the extent possible. But to your first question, so as a research team, for example, we would be covering something like 360 odd stocks as we speak. And in that live coverage of 360 odd stocks, for the ESG fund, we make two levels of exclusions. First, there are certain sectors, for example, tobacco, fossil fuels, etc., which are outright exclusions for us. But these are usually small sectors with not a lot of companies in them. But apart from these small sectors, everything else from a sectoral standpoint is investable to us. But what we also then want to ensure is that, for example, think of chemicals as a sector, right? There'll be companies there which are following the right, effluent treatment practices so that hazardous material doesn't go into the environment. For their employees, they might be, putting in the right safety protocols in place so that they are not subject to hazardous working conditions and so on. But there will be other chemical companies where all of this will be absent. And you do want to differentiate that in an ESG fund, right? So what we typically do is we rely on some external rating agencies. Plus, we also have an in-house ESG team, and we've created our own ESG frameworks. Thanks to the parentage of Amundi also. Amundi is a partner in the JV. And they are one of the pioneers in ESG in the global asset management space. So through that learning and through our own frameworks, we've been able to create an in-house framework as well. So usually the approach is that first remove these sectors like tobacco, fossil fuels, etc. Of all the remaining sectors, including chemicals and so on, you then tend to remove the bottom 1/3 of the universe of that sector on these external and internal ESG frameworks, which are all objective in nature, right? There's no subjectivity there. So essentially, when you start with a universe of 360 odd stocks, you are still left with, let's say, roughly 200 odd ESG investable companies.
How do you look at some of the stocks like an ITC or a Reliance, right? But by objective, they would get eliminated. But from an ESG point of view, these companies have a lot of work they have done so that they are environment friendly, they are ESG compliant, they have a good rating. So is that the only thing? Means you don't look at how companies are performing on an ESG?
So, I mean, I unfortunately will not be able to comment on specific
No, I'm not saying. I'm saying. I'm just. I've taken this as an example
but,
to.
but overall, our approach is that obviously, as I said, there is a sector level exclusion. If something is falling in the wrong sector, it will have to sort of get eliminated. But then the ESG scores per se, they change over a period of time as companies make more progress. And again, the ESG team at SBI Funds Management, we are not just following a very passive ESG scoring and so on. Right? We are a bit active about it as well, wherein we engage with companies, we help them understand the areas where they are lacking on ESG and potentially, work with them on improving on that part. So it's a engagement driven strategy, not a very passive strategy. And as a result, you do see that over a period of time, companies do change in terms of the actual practices, the disclosures around ESG and so on. And hence the ESG scores themselves may change over a period of time. And that's something that we are very open to explore.
I was a little surprised with the allocations which you have, which market cap based allocations, because between mid cap and small cap, you had nearly 70% allocation in the ESG fund, and large cap is 24%. One would have imagined that large caps are much more ESG compliant, but it's the your exposure seems to be suggesting that there are many more small and mid cap companies who are much better in ESG compliance.
Right. So I think it's both. There is a bit of misperception that not a lot of mid and small cap names are ESG compliant, which we disagree with. There are quite a lot of good companies there, which they are small because they operate. I mean, either they are very early on in their business cycles, or they operate in industries which are usually smaller in nature. But many of these companies are following the right sustainable practices on ESG and so on. The other aspect is that we are running a very concentrated strategy, right? 20-25 names at any point in time. So 70% of, let's say, 25 names would work out to something like 16-17 names at max. So to get good, a bunch of 16-17 ESG friendly investable companies, I think that's not a challenge. And again, the other aspect that we all need to keep in mind is that for us, ESG is not just best in class ESG investing, right? Where we are just buying green energy or hydrogen or renewables, and so our main objective is to make money. But what we are also doing is that by removing the bottom 1/3 of the universe on ESG scores, we are trying to eliminate accidents to the extent possible. And this is especially important in the mid and small cap space, right? Because we all know that mid and small cap investing is supposed to be very lucrative. High growth rates, early business cycle, early on in their business cycles, decent valuations and so on, research arbitrage, etc. But there are also many accidents in the mid and small cap space, because not a lot of these companies are being run like institutions with a sustainable framework for growth in place. So when you bring in a sustainability element like ESG, marry it with mid and small cap investing, I think it makes for a good combination where you can hope for the upsides while also trying to mitigate the accidents to the extent possible.
Great. Gaurav, stay tuned. We will be back after a short break where we're going to discuss some of the sector allocations and which are the sectors where Gaurav is very bullish, and some of the sectors where he is underweight. Stay tuned. Welcome back. You're watching NDTV Profit, and this is the portfolio manager, and my guest today is Gaurav Mehta, who's the CIO Alternatives Equities for SBI Fund Management. Gaurav, what I see in your portfolio is that you have a high concentration of consumer discretionary. Can you give us an idea of why have you gone high bet on a consumer discretionary, and is there any sub sectors within which you are more invested there?
Right. So I think what we tend to follow is a GICS sector classification, which includes auto and auto ancillaries in consumer discretionary. So I think the exposure that you see is comprised partly of auto and auto ancillaries and partly of pure discretionary. That said, these specifics.
So 36%, how much would be autos?
So maybe half and half,
okay.
Right? But these specifics aside, I think overall, if you look at the GDP print, for example, you will see that investments has done well over the last 3-4 years, while consumption has lagged. And there have been plenty of reasons around that, including the high inflation and COVID hit and so on. But I think some of those factors have now started to recede. Inflation is coming off. It was a big pinch on real disposable incomes. So that pinch is now sort of starting to wane. But beyond the here and now, I think, we are at $2,300 per capita GDP at this point in time. And history from, economies have moved from $2,000 to $3,000 per capita GDP suggests that, you see a very disproportionate benefit on discretionary consumption. You're already consuming sort of hair oil and soaps and those kind of staple products, right? But your ability to spend on leisure, air travel, on, better health care, buy more sort of air conditions and so on. So I think all of that discretionary spend gets a disproportionate benefit when the per capita GDP moves from 2,000 to 3,000. So to that extent, I think we are at that stage as an economy where some of these categories can see a big fillip. So the here and now was unfavorable, but it's turning favorable because of inflation coming off. But the long-term structural story is as strong today as it has ever been over the past decade or two in India. So we continue to be very bullish on that as a secular theme.
What about financials? Within the financials, are you bullish on certain segments of the financials? Yeah?
So I think one aspect related to what I just said on discretionary consumption moving up as per capita GDP rises. The other aspect of per capita GDP rising is that as you earn more, you save more, you invest more. When you're earning less, a large part of your investment patterns go to, or a large part of your income actually goes towards consumption. As you keep earning more, you don't consume that much more disproportionately, right? You do consume more discretionary versus staples, but then on an overall pie, your investments into savings and investment related products also increases. So I think within financials, that's one bucket, investment and savings related plays, whether it's capital market and so on.
Normal banks you're looking at.
So even beyond banks, I'm saying, for example, capital market plays and so on. I think they also for us are structural investment categories. Banks, we have been very selective on, but I think after the massive underperformance that banks have seen, the valuations there have started to turn very reasonable, especially on some of the larger private sector names. And when you think of the other aspect that's working very well in India at this point in time, which is this entire investments and manufacturing led recovery, you eventually need funding for those projects, right?
True.
And good quality lenders are going to provide that funding.
So you have industrials and materials, which is nearly 20% of your portfolio in that sense.
So I think, if I were to think of three main themes that we are very bullish on at this point in time, apart from this, rising per capita GDP, which will lead to consumption and savings and investment related plays. The other two themes are manufacturing and related plays. So some of these private sector banks in that sense become important because they sort of supply capital to this manufacturing-led growth. But in general, subcategories of manufacturing, subcategories of investments, are something that become a very important part of our portfolio. So overall, you will see industrials, manufacturing, these kind of names, some niche sub-themes of these as a very disproportionate part of the portfolio. So that's the second theme, manufacturing, investments and related plays. And the third theme that we are also bullish on, which may be a little volatile in the near term given the global growth backdrop, is the fact that commodities have seen a massive period of underinvestment, right? There's hardly been any capital expenditure on that front for the past decade or more. They've underperformed financial assets quite meaningfully. And then if you look at the world today, the policy mix is changing from, last decade was all about loose monetary policy. Last couple of years or more have been more about fiscal expansion, not just in India, but across the globe. And as governments spend more money in infrastructure creation so that they can spur job growth, and that in general leads to an environment where growth is decent, inflation is high, I think that entire environment tends to be very conducive for hard assets, right? Whether it's real estate, whether it's infrastructure assets, or whether it's natural resources like commodities. So I think that entire complex, hard assets, infrastructure, commodities, I think that's the third pocket that we are bullish on. And which is why, you see that disproportionate share of materials and related sectors.
With the real estate, are you more bullish on the developers or the real estate allied sectors?
So I think there are different ways of thinking about real estate. You play developers, you play allied sectors like, housing, building material plays and so on. And a third play that we've also been very focused on is that, when you think of this entire overlap between real assets and physical assets doing well and discretionary consumption being at a J curve at this point in time, I think something like, let's say, hotels, hospitals, malls, they become very interesting because they are a play on both. Right? As people earn more, their aspiration to spend on better healthcare or to go to a mall or to sort of spend money on leisure and hence go to a hotel also increases. And then these are also real estate plays, right? There is a hard asset that's already in place. As inflation catches up, your revenues increase, but your cost doesn't increase disproportionately. It's all fixed cost. A large part of it is fixed cost. So the benefit to your bottom line is quite disproportionate.
Basically, the annuity income which comes in some form.
Not even annuity. I mean, for example, think of a hotel company or a hospital company, right? The ARRs can grow at a decent clip as inflation is high. But the cost that they have to incur is all fixed in nature because that hospital is already in place, the physical infrastructure is already in place, the hotel is already in place, the physical infrastructure is already in place. So the pass-through to bottom line is quite disproportionate. So I think that's another way of thinking about real estate.
In the real estate space, I just want to get your thought. The last 4 or 5 quarters, we've seen people preferring allied real estate, and they were not looking at real estate asset. They were playing on the theme of how consumer-centric allied real estate, cable and wire companies and others are performing, and we're seeing a good run-up happening there. But there's always the risk of this governance that comes to play for mid-cap and small caps. Real estate always had that issue, overhang, which is there. Now we are seeing that happening in the allied sectors as well. How do you manage as a fund manager that kind of risk?
Again, I won't say that there are not well-governed names in that sector. I think there are. But yes, you're right that governance is paramount, and in ESG we obviously explicitly model it through the environmental, social and governance measurements. But even in Eon Alpha, which is otherwise an unconstrained and more flexible strategy, even their governance is something that we are very, very, very sort of cognizant of. So anything where we have any doubts on governance, and again, when I say governance, we've tried to objectivize it to the extent possible. The ESG team has a governance framework in place. We run an accounting framework, a forensic accounting framework, where we look at financial ratios basis published annual reports, and then use those ratios to get some sense of whether the annual report actually does justice to actual business performance or not, or is it more, a creative accounting that's at work, right? Because for us,
are you able to do that? I mean, in the sense, bifurcate between creative accounting and actual ones?
Yes, I would think that the framework does a very good job. Obviously, no framework is foolproof, so there are always type 1, type 2 errors. But on the whole, our experience with the framework has been that it does a very good job at identifying clean accounting companies versus suspect accounting companies.
Which are the sectors who are underweight actually? Because I can see IT is a bit 1% odd in your Eon portfolio, but as a whole, I don't see IT part of the, if I'm not wrong, with the ESG.
Right. So I think overall, our approach in these funds is to be very bottom-up in nature, right? So at any point in time, what we are trying to say is that, which are the 20-25 businesses that will give us non-linear returns, not even non-linear, but they'll give us superior risk-adjusted returns for the next 3 to 5 years. IT, unfortunately, at this stage is a name where from a earnings growth point of view, we can't sort of build in a 15-20% kind of a narrative on IT, because when you're just buying 20-25 names, you are looking at a high earnings growth expectation to begin with, which is not the case with some of the IT names at this point in time. Plus, from a valuation standpoint, I think IT stands at a point where valuations are already maybe ranging between 1 to 2 standard deviations above historical averages. And then when you think of the entire global narrative, right? Yes, you were expecting a recession 12 months ago globally. The economies have done relatively better, but the lagged impact of the policy tightness, to what extent will it lead to a global growth slowdown is yet to be seen. So to that extent, the macro environment for IT again doesn't seem to be very conducive. So all of those factors put together, the longer term 15-20% growth expectation being very difficult to find in a sector like that, the valuation still not being very cheap, and then still some headwinds from the global growth side. All of that, at this point in time makes us a little underweight on that sector. That's it, for us. No sector is like a complete no-go. We are always active in trying to identify the next opportunity. But yeah, unfortunately,
but it's a hard choice between return versus governance standard or ESG score.
thankfully, IT is a sector where
ESG score
governance
is
has
very high.
been less of a challenge. ESG scores are
But
usually
returns
high.
are not coming in.
Exactly. So, and as I said at the beginning, right? I mean, our objective is not to buy something because it's high up on ESG, right? We want to generate returns, and which is why we want to eliminate suspect ESG companies. But from the remaining universe, and thankfully to the extent that you're only creating portfolios which are 20-25 stocks in a go, so you can afford to be very, very selective.
Gaurav, it was a pleasure talking to you today. Thank you for joining us on the Portfolio Manager.
Thank you, my pleasure.
Thank you for joining us on NDTV Profit.